Hello and welcome back to the Project Management PrepCast. We discuss the advanced tools, techniques and methodologies you need to understand for your PMI certification exam. I'm your instructor, Cornelius Fichtner. One such advanced methodology is Earned Value Analysis, or EVA. It is also much more commonly known as EVM, but most people simply call it Earned Value. It is a method of monitoring project performance and progress for each planning package or at the control account level. And it is, of course, the topic of this lesson. To be more specific, we set the context of where earned value analysis lies within project cost management. We explain and define and describe EVA. We look in detail at project variance, indices, and how to interpret them. We also cover some more advanced concepts of earned value analysis, including various methods of forecasting. For example, we discuss estimate at completion, or abbreviated EAC, with detailed scenarios for each method of determining the potential estimates, and we cover variance at completion, usually shortened to VAC, percent spent and percent complete. Finally, we discuss the To Complete Performance Index, simply referred to as the TCPI. As you can tell, there are a lot of acronyms and more math. This is a three-part presentation because earned value is a big topic. Right now, in part one, we go through an introduction to earned value with some history on where the earned value methodology came from and an exciting discussion on building houses to understand variance. In part two, we cover indices and forecasting, and then in part three, we discuss estimate to complete and to complete performance index, as well as various miscellaneous formulas. The main concept behind the earned value management methodology is providing an objective tracking tool for your project's progress. It does this by helping you plan expenditures from the WBS planning packages by date to judge progress against the schedule and to create a baseline, and using the actual costs to determine cost performance relative to that baseline. It differs from other methodologies by using a baseline that accounts for only 100% completed work. The resulting benefits of the methodology are many. EVM is objective. The costs are based on invoices, charges, and whether an item is complete. Earned value is based on financials and provides two different ways to track a project's progress. The obvious is that it provides budgetary tracking. It quickly highlights how our costs are being managed. It also helps us track schedule by only allowing credit against expenses after an item is complete. In EVM terms, the item has to be earned. This allows us to see the degree of completing the scope to the schedule. Many aspects of the analysis side of EVM, called EVA, are graphical, using graphs to represent the project's progress in a common and friendly manner, as you see throughout this lesson. The methodology is also late task-centric. Since we are usually more concerned about late items, earned value analysis highlights these late items so that we can take corrective action quickly. Earned value is not right for every project, but there are many organizations, especially the government, that use it regularly. This lesson provides you with a good foundation to be able to understand earned value, but you don't need a degree in accounting or mathematics to understand earned value. Knowing some basic business accounting helps you to understand the concepts and helps you to better communicate with stakeholders. So you are not wasting your time trying to understand these concepts. Understanding differences and ratios from a mathematical perspective also helps, but in reality, neither is necessary. They just make you a better project manager. What you need is some resolve to study this topic. Like anything you learn, the more you practice, the better you will be at it. I explain the basic earned value formulas to you in this lesson. However, this is really only the start in your studies. In order to get exam ready, you have to practice these formulas, think about what they mean and how changing the numbers changes the outcome. The best way to practice these concepts is by working your way through sample exam questions. And here are two recommended resources. First of all, PMformulas.com is our own separate product for formulas. And second, the PMExamSimulator.com allows you to practice on realistic exam questions. Both resources are an immense help in preparing for your exam. We begin with the definition of EVM. Earned Value Management is a methodology that combines scope, schedule, and resource measurements to assess project performance and progress. There is definitely a focus on cost in earned value management, but as mentioned in the introduction, it does not just look at the monetary progress of the project. It also factors in schedule and resources, for instance, money. That makes it a nice way to package up progress monitoring. The performance measurement baseline is also known as the cost baseline or planned value in earned value management. It encompasses the scope, schedule, and cost baselines. A quick history lesson on earned value is a great way to help you understand its application, penetration, and importance in government and business. It all began in the 1960s when earned value-based performance management had its inception in the United States Department of Defense, the DoD, as the Cost Schedule Control System criteria. Earned value was developed as an objective method of measuring completed work in defense projects. Later, in the 1970s to 80s, the DoD expanded its use of earned value in response to having to bear costs and schedule risk in cost-plus contracting. You can imagine how, at the time, pushing high technology and newly developed weaponry was top of the DoD agenda. The military had high visibility schedule requirements in the politically charged environment of the arms race. Project risks were high due to the new technology. The budgets were enormous, and politicians wanted to know that projects were running well. By the 1990s, a policy was introduced requiring earned value to be used in all federal agencies, including the likes of NASA and the Department of Energy, who had a history of late and over-budget projects. Many contractors and companies catering to the U.S. government simply had no choice but to adopt earned value management, which they still use today. You can see that EVM arose precisely to fill the need for assessing project performance and progress. But that does not mean earned value is perfect for everyone. There are many critics who say that earned value analysis formulas and techniques are too complex, they add a layer of overhead, and they result in too much bureaucracy on projects. The added work makes it difficult to apply the earned value methodology to small projects as well in a cost-effective way, simply because of the amount of extra work. Tracking and measuring earned value is also time-consuming and costly. Some EVM projects have a team member dedicated full-time to tracking and reporting earned value. Perhaps the project would be better served if this resource was dedicated to directly contributing to a deliverable. Although there is a branch of EVM for Agile called Agile EVM, the overhead is often considered too burdensome and conflicts with a number of Agile principles. Some of the concepts, such as deriving schedule variance from cost, are difficult for people to understand, and EVM can be argued to be too big a generalization. On the flip side, you are likely to find many who disagree with these critics. They would claim the opposite and sing praises as to the immense benefit of earned value management. So, where does that leave us? Although it's important to be aware of the pros and cons of this debate, for preparing and taking your exam, you should set it aside. So, I want you to repeat, or maybe even shout, the following sentence every single day. Earned value management is the best thing that has ever happened to project management. Yes, in other words, you must forget your personal feelings about the earned value management methodologies for the exam. PMI is a strong supporter of this methodology, and you must know it and be able to apply all the formulas for your exam. Getting comfortable with earned value starts by knowing the family of acronyms. Here are the 10 most common ones. These are not the only ones you need to know, but I show you these because I'm not always going to decode them in this lesson. So take a couple of seconds to absorb them here. Planned value, PV. Actual cost, AC. Earned value, EV. Schedule variance, SV. Cost variance, CV. Cost performance index, CPI. Schedule performance index, SPI. Budget at completion, BAC. Estimate at completion, EAC. Variance at completion, VAC. I'm going to assume that you know them. I'm not being lazy here. I want you to feel perfectly comfortable using them. I'm sorry to say that you need to know them all. Just like they were members of a big family. You don't have to like them all, but you need to know their names and how they relate to you. Keep reminding yourself, although you don't really like your cousin Vinny, you need to know who he is and what he does. That said, our mission is to help you become fluent with these acronyms, terms, and equations. The foundation of earned value consists of these 3 acronyms here: PV, AC, and EV. These 3 elements are the basis of all the earned value formulas. PV is planned value. It is the authorized budget assigned to scheduled work. This came from our budget planning and tells us how much money we plan to spend at given times on the project. AC is actual cost. It is the realized cost incurred for the work performed on an activity during a specific time period, or in cash flow terms, these outflows are what we have spent. EV is earned value. It is the measure of work performed expressed in terms of the budget authorized for that work. The operative word is performed. In other words, completed, not partially completed, but completed in full. If we are 75% done with a task that is planned to take $1,000 complete, we have earned 0, not 750. This is one of the most important concepts in earned value and also why this methodology works. To help cement the earned value concept, it helps to use 1 or 2 examples. The first one is a housing construction example. In fact, when you look around, you'll notice that about 90% of examples for earned value use housing. So why not? Even though earned value can be used in many types of projects, using a construction example is usually easier to explain and easier for you to conceptualize. The example is oversimplified here to get the concepts across. We're not trying to turn you into a construction general contractor here. So, in our example, we are going to build 6 houses. While defining the scope of this project, we determined that each house should be broken down into 3 planning packages. The first is the foundation, which takes 1 week. The second is framing and exterior work to enclose the house and seal out the weather. This should take 2 weeks. And the last phase is the interior work of installing heating and cooling, hanging and painting drywall, laying carpets and floor covering, and putting in fixtures, appliances, and the like to make it attractive and livable. This takes 3 weeks. Therefore, it takes 6 weeks to build each house. We now move on to understanding the cost and other details. As we develop the work breakdown structure, we decide that control accounts correspond to the same 3 planning packages so that we can track progress at that particular level. So, while planning, we determine that the foundation's cost would be €30,000 each. Framing and exterior cost would be €70,000 for each house, and the cost of the interior work and finishing would be €100,000. When you add them up, the total cost for each house is 200,000 euros or 1.2 million for the entire project for building the 6 houses. The logic for these breaks is twofold. First, there are different crews with different skills doing these jobs, and second, they are logical stopping points if home sales or prices suddenly drop. It is important to understand that measurement points need to have meaning in the project's business domain. In this example, having a costing point where only the forms for pouring the foundation's concrete are in place does really not make sense, because we have not really achieved anything of real value at that point. We need to pour the foundation, not just have the framing in place. So we start our project and build the first 2 houses pretty much according to plan. By week 14, we have built 2 complete houses and we are working on the foundation of the 3rd house. At this point, the project has a planned value of 430,000 euro, or 200,000 euros for each of the houses that are complete and 30,000 for the 3rd house's foundation. Unfortunately, we have not finished the 3rd house's foundation. This means we have not earned the 30,000 euro for this foundation. Therefore, our earned value is only 400,000, just the cost of the 2 completed houses. We add up the cost of labor, material, and equipment spent to date, and we get an actual cost of 420,000 euro. Since the equation for cost variance equals earned value minus actual cost, we have a cost variance of negative 20,000 euro. A negative variance means that we have not gotten the value that we have paid for. We haven't, because we have spent money on the 3rd incomplete foundation, but we haven't earned it yet. It's not done, it's not complete, so there is no earned value coming in. We can see that in the chart to the left, as it shows our earned value, it is less than our actual cost. It is important to remember that cost variance is not the same as budget variance. Budget variance is planned value minus actual cost and is not a factor in earned value, since it does not account for work completed. Being on budget has no relevance in EVM. Some stakeholders ask for the budget variance, but budget variance does not consider the scope of what you are doing. For that reason, earned value management defines earned value as for completed work only. These seemingly subtle differences in meaning between cost and budget variance are extremely important for you to understand, not only for your exam, but also for communicating with stakeholders. The EVM methodology is designed to tell the stakeholders, which includes you, the project manager, whether expenses are commensurate with the work completed. It is not the same as the project's budget, cost baseline or planned value. In this example, our project is 10,000 euro under budget. We had planned to spend 430,000 euro, but have only spent 420,000. But we have not finished the foundation. So saying that we are under budget is correct, but extremely misleading, because the cost variance is showing that you needed to spend the additional money. It is like saying that we were supposed to drive 500 kilometers but have only driven 450. In the driving analogy, we can clearly see we are not doing better. We are behind. There are 2 key factors that you must remember. First, earned value is not planned value. It is the value of the work that we have completed. If you have not completed the work or some component, the earned value for the component is 0. This concept comes from the idea that something that is half done adds no value to the deliverable. That seems unfair, but half of a house's foundation is a liability, not an asset. The second item to remember is that earned value should be set at a logical business point in the project. This is accomplished by defining the planning packages correctly. In the case of our houses, there are 3 planning packages: the foundation, the framing and the exterior, as well as the interior. After we have completed all three, we have a house, but the three planning packages are logical value points of the project. By structuring our project this way, we can see if our spending as planned relative to what the project has accomplished is correct. The next formula that we need to understand is schedule variance, or SV. At first, it may seem counterintuitive that we are going to determine how we are doing to schedule using cost figures, but trust me on this one, it works. By looking at what value we have accrued relative to what we have built, we can see if we are performing to schedule. In this example, we have an EV of 400,000 euros on June 15th instead of June 1st. Maybe I can convince you by ignoring the equation. Look at the S-curve to the left. You can see the earned value, which is the green curve at the bottom, and the planned value, the purplish line on the left. On June 1st, we plan to have earned 400,000 euros, but we did not earn that until June 15th. We are 14 days late. The curly brace shows the 14-day gap between when planned value and earned value should have been equal. You can see the gap. It is easy to see that the project is late and truly behind schedule by just looking at the two dates for when the amount was earned versus when it was planned. However, we cannot do the math on cost at two different dates. It simply does not make sense. So we choose the current date and look at the difference between the earned value and planned value. This is the essential point in a potential trend to use earned schedule. Using the values on the same date also shows the gap, but it's not as intuitive. However, that gets us to the formula for schedule variance. Earned value minus planned value. In other words, we take the value of what we have completed and subtract what we planned to have completed at this point in time. This represents the slide in our schedule based totally on financials and what we have earned. In our example, we are in week 14. Our earned value is only 400,000 euros, but our planned value is 430,000 euros. But as the foundation for the third house is not complete, our schedule variance is negative 30,000 euros, which means we are behind schedule. If our earned value had been greater than 430,000, we would have been ahead of schedule because the schedule variance would have been greater than 0. And this is probably a good time to take a break and let all of this sink in. So here are some takeaways that you should note. The two variance formulas are cost variance equals earned value minus actual cost, and schedule variance equals earned value minus planned value. Variances greater than or equal to 0 are good. The project is on or ahead of schedule. Variances that are less than 0 are bad, denoting the project is behind schedule. At the end of the project, schedule variance is always 0. This may seem odd, but as schedules and budgets change requests are submitted so that the cost baseline, the planned value, is correct. Therefore, in the end, planned cost always equals earned value. The project may be way over or under its original budget, but that is not part of earned value. And that's it for part 1 here in Earned Value Analysis. See you in part 2. Until next time.